All right, so can you really borrow from a life insurance policy? And if so, how does that all work? Well, in this video, we're going to talk about how do I actually get my money work for me and not just borrow from it, but also how I can use it to create more cash flow, more freedom, so I can actually get to the point of retirement much faster. So in this video, one, we have to figure out how do you actually set up the right policy. Secondly, how do you actually borrow from it? How do you really use this? Right? Because we know we can borrow from it, but how do you really use it? And then of course, lastly, and this is the most important, how do you not just use it and borrow from it, but how do you use it to actually make more money with it? That's what we'll talk about right now. Okay, so first and foremost, how do you choose the right kind of policy? Because there's a lot of confusing information out there, and if you start going down this YouTube rabbit hole, the truth is that everybody's got their opinions, everybody thinks they're doing it the right way, but the truth is that I'll tell you from my experience, that's not the case. First and foremost, when I learned about this, it was a shocker, okay? I started out as a financial advisor. I used to tell people, throw your money in the stock market, gamble it away in there, and hopefully someday you might have some money there, assuming you're in long enough, like 80,000 years or something like that, right? But when somebody started telling me, you can actually use life insurance policies to invest your money. I'm like, wait, it's an investment? They're like, no, it's a savings account. You got this tax-free savings account, but you can actually use it to invest in other things. I said, well, how does that work? How can you really do that? They said, well, first and foremost, you use a whole life insurance policy. And I said, whoa, hold on. I know whole life insurance policies, they suck. At least that's what I was told by other people, by other financial advisors. They must be horrible. They don't pay you anything. They're like, that's not the point. The point is you can actually borrow from the insurance company to use that money to invest and make money in other places. And remember, I wasn't thinking about that. I was thinking it's like, let your money sit there, right? You just put your money in the whole life insurance policy, let it sit there and grow for years and years and years, decades, right? And then finally, when you're able to retire, you might start using that money to live on. And it's tax-free income, but I wasn't thinking about you can actually do something with it right now. And that's the key difference is that, when they talk about you can access money two ways in a policy. Yes, you can withdraw the money. That's a very possible thing you can do. But the second thing they hear everybody talk about, they say you can borrow the money. And the number one question people will always ask me, they'll say, Chris, why would I borrow my own money? Why would I pay interest for my own money? And the answer is you don't. You don't pay interest on your own money. What you're doing is you're borrowing the money from the insurance company. Why would you do that? Because of this one reason. Because your money's over here still earning compounding interest tax-free. They're paying you right now, they're up around 6% a year tax-free, depending on the insurance company, while they're also charging you about 6% on the loan rate. Now you might say, well, I'm not making any money. That's what I thought too. But here's what I learned. When you borrow that money, yes, they are charging you interest on that money. And yes, you do pay them back interest. Do not believe for 1 second on all the YouTube videos I've seen out here, people say you pay yourself back interest, you pay yourself back. No, you do not. You do not pay yourself back interest. You are literally paying interest to the insurance company. Don't believe that lie for 1 second. But here's where it is advantageous, is that say I do borrow that money from that insurance company, but then I go and I invest it, say into a real estate property where I make 10% a year net profit. Well, that 10% a year, say it's $100,000 I'm taking, right? Well, now I'm earning $10,000 a year from that real estate. Yes, I paid them 6%, but here's the cool thing. That 6% I'm paying them, that charges me $6,000, but they also paid me about $6,000 in interest. So it kind of washes itself out. But now I have this $10,000 I now pay onto that loan. So I've now paid that loan down. Now I only owe about $90,000 or so. And now they're charging me 6% on $90,000, right? And here's how it keeps growing and going, because now I only pay $5,400 in interest while I'm still earning it. I'm still earning more than $6,000 in interest over here. And the next thing I know, I'm making more in interest from my policy because the money just sits there while I'm borrowing it from them. But the cash flow I'm earning is paying the loan balance down. And the cool thing is, as it's doing that, because I'm still earning more interest, I make more interest to go help me add more to that savings account that I can then use to invest again. That's the power. I'm making money in two places at the same time. Now, if this is just a 1 year snapshot, you'd say, well, I'm not making anything. I might even lose money sometimes. And that's okay. Because as you take the cash flow from the investments to pay the loan down, you pay less and less in interest while they're compounding more and more and paying you more and more interest every single month and or year. That's the beauty. That's how I make more with that policy. But to really make this work, you have to have the right kind of policy. It has to be designed the right way. Most people, when they set up life insurance policies, most insurance agents are just that. They're insurance agents, they're salespeople. They're just trying to sell you something that might be okay for you, but let's be honest, they're trying to pay for their family too. They're trying to earn money off of this. And so sometimes they'll give you a good deal, but not the best one. So be careful of that, because you want what I call a max ROI infinite banking policy, where they lower the cost as low as you can go, And then as we lower those costs to the minimal amount, less money is coming out, allowing your money to grow faster. This is a key thing that you'll want, is that you want to be able to grow that money faster. It doesn't matter what kind of returns you might think you earn on the policy if the costs are higher. Think about this. Let's just say there's a policy that says, I'll pay you 8%, while this other one only pays you 5%. However, the one that pays 8% will also cost you 10% more in costs. Compared to the 5%, a 15% return, that 8% will never pay 15%. And that's why the cheaper one wins. You want the lowest cost policy possible so that you can allow your cash to grow faster, invest it faster, and that's where you make more money. All right, so I'm often asked, like, how do you actually get a loan from the policy? It's actually pretty simple. You go to the insurance company, you actually reach out to them. Sometimes they'll have you fill out a form, sometimes you can do it online, but you request a loan. There's no credit check. There's no need for a great credit history or anything like that. It doesn't even show up on your credit report. This is a private loan that they give you. They're willing to give it to you because they know that the cash over here is guaranteed. They're using your cash as the collateral so that they feel safe to give you that money. They'll usually loan you up to about 90 to 95% of whatever cash is over here. That's what they're willing to give you as a line of credit. You can pay it back, however, whenever you want. The deadline is your death. You have to pay it back by the time you're dead. And they just take that out of your death benefit and pay your family the rest tax-free. But there's no minimum monthly payments you have to keep paying on. That's not the case at all. They know because they're paying you interest that interest kind of offsets the interest they're charging you. And so you can pay it back however, whenever you want. This is wonderful, especially for those of you that are business owners, those of you that are real estate investors. You love this. Because for example, I have friends that are real estate investors that they might want to go buy a piece of junk property at a really cheap price that they want to renovate and then sell for a much higher price. Well, when they do that, if they have to borrow money from somebody else, they're going to want interest all the time. And so they have to pay interest on that. Or even if they borrow money from the bank, they have to pay interest payments every month while they make no money and the clock is ticking against them. It creates a little bit of stress. But with the insurance loan, because you're getting that line of credit and there's no monthly payment, yes, they charge you interest. However, you don't have to pay it back, at least not right now. And so what they do, as the money comes in eventually when that property is done, they can then pay back the loan. If they choose, they could just pay the interest. They could pay nothing. They could just let the interest compound. Warning, my personal preference is don't let the interest compound against you long term. That is not very helpful, but you do have that option. Just know that. I had one person that was a real estate investor that she and her son partnered on a deal. It was $125,000 that they borrowed from their policy. A year later, they got paid $155,000 from the sale of that property. So they're feeling great because they just made $30,000. And she asked me, she said, Chris, should I pay off the loan or should I not? And I said, well, do you already know what you're going to do with the money that you've earned? She said, yeah, we already have another real estate investment in the works. I said, great. If you want to keep the money from compounding, pay the $6,000 of interest or whatever you owe for the last year, and then use the other $150,000 to invest. You can do that. You don't have to pay off the loans, right? That's the great thing, is that you can always keep using it. Again, warning, they are charging you interest, so be aware of that. But the great thing is that you're very flexible. As a business owner, you know this. You want flexibility. If you have some strategy you're going to use, maybe you're trying to do a big marketing push, but it might take 6 to 12 months before you start to see the money rolling in. Isn't it great to know that you don't have to make any payments to that at all? You can access the cash, use it, but as the money starts to finally roll in, then you can use that money to start paying it back, start to pull out more money to reinvest again. And by the way, if you're paying interest to an insurance company and it's a business expense, guess what? Tax write-off, you got it. So it's not just like the double dip effect where you make money over here and over here in the investment or the business strategy, but you're also getting a tax write-off on the interest you are paying. So you get another additional benefit. So if you're a business owner, this is a no-brainer. This is an amazing strategy for you to use to be able to make more money with your money. And that's kind of the whole point, guys. It's not just about whether you can borrow the money or not, but how do you use this money to actually make you more money? This is what speeds up people to create more wealth faster. This is how I've had friends do this, where they've actually been able to use this cash to go invest in businesses, do joint ventures and do other type of partnerships and things like that, make the money and use it like their own personal bank where the money keeps cycling through and back out again, and they just keep building and building and building and growing their wealth all the way till they make millions upon millions of dollars. It's the same thing I've done for myself. A lot of times I just let my money sit here just so I earn better money than my bank at point nothing percent. I've had other friends that have lost trust in banks. When we started seeing bank failures in 2023, they started moving money out of the banks, putting it here because it's guaranteed. And in fact, it's safer than the bank because they have reinsurance to back them up, and insurance companies don't fail as often as banks do. So they start putting more money here. So it's a great place to store money, but it's also a great place to make more money and create more wealth faster because you can make money in two places at the same time. But like I said, the key is this. You have to make sure you design the best policy possible so that it has the minimal cost coming out, allowing your money to grow faster. The best way to do that is, of course, go to moneyripples.com, go click on our Infinite Banking tab. Not only will you learn a little bit more about it, but you can also book a call with one of our specialists today to figure out how do I design the best policy so I make the most money in the fastest way possible. Go do that right now.